I do like to start off the show every time talking about what we saw in the market this week. Pretty good week. We hit new all-time high quite a few times
Hmm.
this year. We hit 42 times that we've hit a new all-time high this year. I mentioned that in my daily videos, and somebody asked, what's the highest in any one year,
Hmm.
which I didn't know. I went and looked it up, and it's actually 1995.
Yeah, that was a great year.
Yeah, 77 highs. And so the next closest one was actually 2021, which is another really good year, with 70 highs. So I don't know that we'll get there. I think the real issue here for this year, it looked like 1995 at the beginning. If you look at that run up that we had
Hmm.
from October through, the end of March, that looks just like 1995 if you go back and look at that chart, but it kept going
Hmm.
all year long. And what happened this year, we're getting these, you know, false signals in hindsight about, hey, inflation might be picking back up. And so we're in a little bit more tenuous environment than we had in 1995. However, still really good run. I mean, we've been going here. October 13th of 2022 was the low point of that bear market or down
Hmm.
market that happened in 2022. And so, October 13th of this year, we'll be at 2 years.
Yep.
Yeah. And so the average bull market, if you go back to the 1920s, is 3 years, right? The average bull market, if you go back to 1970s, is actually 5 years. And the reason that it's longer now is because of the, kind of the financial, engineering that goes
Hmm.
on with quantitative easing and these stimulus programs and those types of things that they've discovered, that help us move maybe a little bit quicker and longer.
Yeah, they
Uh,
kind of try to stabilize as much as they can.
yeah, it kind of juices the system, so to speak, which is fine. Obviously, the problem is we keep, increasing the debt load. And as long as we can continue to, sell our treasuries and, we can continue to do those types of things. But so nonetheless, just keep in mind that, this is still, I think, in the earlier innings of this overall run up, right? And, even if it's just 3 years, we still have a year to go, which would be fine, as far as that goes. And what they look at here, what ends these runs is a 20% or more downturn, because that's officially now called a bear market. In our case, that means the primary direction is now down,
Hmm.
that kind of thing. So primary direction is definitely still up. Market is doing quite well, actually. I will say it continues to rotate, right? We're seeing, kind of day by day, all of a sudden the small caps are doing well, and then they're not doing quite as well. And then, we got the utilities run, and then they stop. These runs are not very long, right?
Hmm.
And so it's very difficult if you're like with our target pieces, to kind of stay ahead of a trend that doesn't last for very long. And again, the big win here is to have very broad portfolio in this time frame. If you go back to 2021, which is the last time I remember this type of thing happening, the big winner was like the Vanguard Total Stock Market Index. It had the small caps because it basically has all caps. I mean,
Hmm.
it's almost all of the stocks in the U.S. market. So I would definitely encourage, and we're doing the same thing, a broad spectrum for a big chunk of your portfolio if you have that capability. And last year, the beginning of this year, you could have pump money into the big seven and
Yep.
outperform the market,
Hmm.
right? And that's not as true right now. I do think there'll be a trend that is established here at some point in time. There always is. I think, there's too many cross currents right now. Inflation, no inflation, recession, no recession. Who's in the White House? Who's in the Congress, right? And so it's just going around in circles. However, overall, it's still going up. And actually, we're going to end up, it looks like, with a positive month in September, unless there's a really big day. I think
Yeah.
the last day is Monday.
Yeah, I
Yep,
think so.
yep.
Yep, Monday's 30th.
So that's not that common to have a up month. However, we did present on the show during presidential election years. September does buck its trend by being up slightly.
Yeah.
On average, going back to 1898, I think we did that
Yeah.
one. That was actually the Dow looking at, but same thing. Well, not same thing, but
Similar.
it's the market. Um, and so I think that's important too. Uh, I'm impressed with what's happened here. So if we zero in a little bit, I showed this last time. Now we went from weekly data in this case to daily data, just looking year to date. So you can see the downturn we had in middle of July to August, and then we fell again at the beginning of September. and then we finally broke through to a new all-time high. And what's really powerful about that is how long we spent. If you look at that, I mean, basically going back to May, we've in that same, time frame of price, right? In this
Yeah.
kind of range. And so we built up a really good base. We broke out of that base. And now, more importantly, we're staying above that base. And we're not coming back in. And it's looking more and more as we're here now a week out on this run that we are, going to stay above this base. Now, all of these things are predicated on kind of momentum and things happening, the past, 5-year runs that the market has, and all those things. You can always have something that changes whatever momentum you have, right? I always talk about if China invades Taiwan as one thing that comes up in my mind that would, it doesn't matter what type of bull market we were in, we would be going downward in that scenario, in my opinion, just because Taiwan makes so much of the semiconductors that the world kind of relies upon. So that would be a big deal. But nonetheless, pretty good market. That's a really powerful piece that you're looking at right here with this base that was built up over a number of months, breaking out of that top. At least what would happen if we did start to come back down, it would slow the descent. Because there's a bunch of people that bought at those prices that now think, hey, if it comes back to this price, I would buy it again, and so there's some support now underneath this run that we're on right now. And we're heading into seasonal good times, right? That November, December timeframe and those types of things too. So really, really not a bad market. And again, this hasn't changed. Primary trends on all the different, hourly, daily, weekly, monthly is all green. That hasn't changed since the last one. And everything except for transportation is green here on the market breadth on the weekly data. So yeah, it's good stuff. Again, it's a good time to be an investor, in my opinion. There's been a lot to be made here, and unbelievable, really. I mean, because we made a lot last year, right? And so I have to do some study on this, but it seems like we have quite often kind of 3 years. So 2019, 2020, 2021, I believe all of those were over 20%. And then we, of course, had 22 with the big downturn. And so this is our second possible over 20% year if it continues to hang in here. And I don't see any real dark clouds on the horizon that would really affect us dramatically in 2025, especially if they're continuing to lower rates during that period of time
and
too.
Interest and inflation's kind of abating.
Yeah, exactly. So, and we'll talk about that too. So here's today's announcement for core PCE. So now the thing about PCE, here we are on the 27th of September. This is for August, right? So it's, a ways back. But it is the most important component of the inflation reporting because this is what the Fed looks at, that they're trying to get to 2%. A little hard to see this, but we've spent the last 4 months at 2.6 something percent year over year. So what that means is we look at August of last month. We would look at August of that of 2024 versus August of 2023, and we see, okay, prices were up 2.63% in this basket that they look at, right? And 2.68% actually in this case. So, but it's really flatlining. Probably should be getting better, but it's flatlining. And so, why did the Fed lower rates? Why would they maybe do a 0.5 point cut? And so let's take a look. First of all, right now, the bet for the 0.5 point cut actually went up today. So even though core PCE year over year came in pretty much at the same number it's been at for the last 4 months, the bet went up that we'd have a 0.5 point rate cut versus a 0.25 point rate cut, right? And we're up to what, 56.7% on the futures market, which is what this represents. So we'll see. I guess I'd be a little bit surprised, but I was surprised by the last 0.5 point cut because they've already done a 0.5 point cut. There's nothing really going. However, there is one reason this bet went up, and that is because if you look at the core PCE on a month-over-month basis, so in other words, if you compare this August to this July in this year, and this July to June, and June to May, etc., and you look at how much growth there has been. So if you take the last 3 months, if you just add them up, it comes out to 0.5%, okay? Rounded, but 0.5%. And then you multiply that times 4, that's 2%. That's exactly where they want to be. And so the reason they're cutting rates right now, and the reason that there's a higher bet on another 0.5 point cut than two, say, quarter point cuts, and is because it's already there. And once it gets there, there is some nervousness about getting below it.
Yeah,
Yeah.
it's kind of like a train. You have to. It
Mhm.
takes a little time to slow down the train, and so
Yep.
once you start to get close to that point, they're trying to slow it down.
Yeah, exactly. So that, and of course it takes so long for these things to really have an impact. And, so we're going to find out next year whether or not, this is working in terms of, did they leave rates up too high for too long this year? Maybe they should have come down earlier or not.
Hmm.
Uh, I'd say it's kind of a mixed bag here on inflation, but you can see where the market is looking as far as that goes. And so now here's something, that is really kind of the main driver of the inflation basket is shelter. Not the main, but one of them.
Yeah,
Yeah.
it's heavily weighted in CPI and PCE
Yeah.
because everyday life, your shelter is such a big cost.
Yeah, and you can see like, what happens to shelter costs during recession, back in 2008, it can go down. But look at what happened to shelter costs during a pandemic. It really went up. And there's a couple reasons for that. I mean, one of the main reasons is that, you had a scenario where lower interest rates. So,
Hmm.
mortgages were cheap. That gets a lot more buyers in there. But house prices went up. I can't remember which year it was up 24%. It was either 2020 or 2021, probably 2021. And so, you get that kind of a explosion in gains and prices. You're going to end up with, people that can't afford it. So they're renting.
Hmm.
And part of this is the equivalent rent for people that actually own homes,
Yeah.
right? And so it's kind of fascinating, but it is coming down, right? It's got a ways to go to get back down into some average area, but this is an area that has to keep coming down in order for inflation to start to get all the way down to where
Yeah,
it
and
needs to
it's
go.
a sticky thing because it's hard to add new supply, whether
Yeah.
it be rental units or,
Yep.
just general housing that people can buy.
Yeah.
You know, it takes time to develop properties.
It does. It takes time for you could have a lease, you're in a place, it's higher than what you might have to pay in the market at the moment, but you've got a year lease, you still got 6 months left. And so it tends to be kind of slow and lags quite a bit too. So, but this is one of the big things. And, rents are pretty out of control in a lot of areas. So hopefully they can get better over time, but we'll see how this plays out. Um, One thing, we were talking about kind of this weird relationship. So you would think that the price of homes would have come down, right? When interest rates went from a kind of a 3% mortgage to a 7%
Yeah.
mortgage, that's usually a death knell, at least for the short term, for the price of housing. It didn't come down. And one of the main characteristics or one of the main reasons for that was because all these people refinanced at
Hmm.
3% or even below that. And it dried up the people that wanted to move because if you go from 3, now I got to move, I'm going to go to 7. And so we were kind of wondering about what happens if mortgages go back down to say 5,
Yeah.
right?
Does more markets or do more properties come on the market because
Right.
people are wanting to, move and there's felt locked in with that 3% loan.
Yeah, it's kind of like backwards, right? So price didn't go down when rates went up because of this 3% big group of mortgages sitting there. Can house prices actually come down when rates come down,
Yeah.
which is totally not
Yeah.
what normally
Will it
happens?
add supply
Right.
by people moving?
Right. Well,
Essentially.
bring in enough supply to kind of soften up the market. It'll be interesting to see how that plays out. That doesn't that's not normal. Let's put it that way. So anyway, that's one of the things we're looking at now. The other big story really had to do with China. So this is a ETF iShare has. It's a kind of a big basket of Chinese stocks. It's the one we generally look at when we want to look at the Chinese market. This is the last 5 years, right?
Hmm.
And you can see just over Easton's head here, the thing is really going.
Yeah, I
Uh,
think it's 20 something like 20% in the last 5 days.
Yeah, so this is because China had a stimulus package, a big one that they put out that the markets are excited about, and we're seeing all kinds of different arenas where it's kind of flooding into gains in those particular types of stocks. But here's the point that I want to make about the overall market. Some time ago, I said, during our higher inflationary period, I said, I'm kind of glad that China isn't really hot right now economically.
Hmm.
And they were struggling, the COVID lockdowns were later than a lot of the countries, including us. And so they're kind of offset. So the rest of the world is moving along and starting to get some of their growth, and the U.S. is doing the best really for the out of the big countries in terms of gross domestic product. But if China would have been hot, I think inflation would still be up there. We'd still be cranking on rates and those types of things. And my wish was that they would get hot when everybody else started to slow down, and it might keep the rest of the second world, second largest economy in the world, might keep the rest of the world out of a heavy recession.
Yeah, they can drag everyone up.
They can kind of come up, and so it's kind of this wave that's coming behind. And I think this is really fascinating. And at the time when we were talking about that, the concern was, oh, China's going to fall apart. They got this big real estate problem and all of these issues. They actually have deflation, unlike ours with our inflationary issues. And I mentioned that, well, they'll probably just do what everybody else is doing. They'll throw out a bunch of stimulus money because it does work. And, the parties in power don't want to have everything fall apart. So if they can get money out there, they'll do it. And there's going to be something that gets done all the time. It's happening now more often in the U.S. since 2008, right? Mm-hmm. And these are tools that they'll continue to use. I do think there's some danger in these tools that keep accumulating, higher debt levels and kind of pushing out sort of a sugar high onto the market, that may not be completely accurate because this government money keeps coming out. However, that could go on for generations for all I know. We'll see how that plays out. But anyway, the stimulus package, I think, will be a big piece of what happens here because it'll translate to us. They're buying products that are, made by U.S. companies, and, U.S. has huge, exposure to China in China. We're selling to China also, right? I mean, whether that's Teslas or what have you. So anyway, that's I think this is a big piece of the story that happened this week also. And so again, good week, lots of good things happening. Inflation's doing okay. Annualizing it out for the last quarter, we're already down to 2%. All of these things that are happening, and the market continues to hit new all-time highs. It's not going up as much as it probably could have been if it was November. We'd probably be going a lot faster right now, in my opinion. We're still heading into this election, so there's still going to be money that holds back here just because, the uncertainty. There's a lot of money that wants to play a particular angle. And the angle kind of depends on how Congress is made up and who's in the White House as to where you might want to play that angle. So, if I got some money coming in, I might want to wait for a while, wait till after that election's done. I'll know what angle I should be playing. They're probably gaming all this out. Mm-hmm. We don't do this, but there's a lot of big hedge funds out there that do this. So, that type of thing is bound to slow down the market at least somewhat until the election. But usually you do get a really nice pop after the election. So we'll see how that goes. So anyway, look forward to being able to, see what's going to happen next week. Thank you for joining us for this particular summary.